Hi, Warriors. James, Bran. Everyone doing okay? Kind of a wild week we definitely had. And I'm sure that the team is here to explain everything to you and me.
Morning, mate.
How you doing, Ryan?
Yeah, how you doing, mate? You good?
I'm okay. Hello, Ann. So why don't we start with you and K-Man saw a little note that the BOJ said that they don't have the tools to defend the yen.
That was a government official. Actually,
Okay, not BOJ.
No, not the BOJ. Yeah,
Is
he's
that
sort of
yeah.
gone off
Is that
script.
a call for the Fed from him?
I don't know about that.
Yeah, you know, he's basically saying, help me, I've fallen and I can't get up.
Yeah, well, probably Finance Minister Suzuki probably slapped his span when he heard that comment coming out.
Yeah, because
That's
I mean,
not the script.
yeah, so here we go. And, you know, I was thinking about it, you know, I thought yesterday when we were doing the broadcast, actually, we made new highs, but it almost looks like, you know, it's incomplete here. And taking out yesterday's low would change the picture, but it almost looks like it wants to make another run up there.
Yeah, if you come in a bit to something like a 15 or a 30-minute chart, this 143.50 has been a bit pivotal. You know, we're up, we're down, we're up, we're down around
right
it.
Here. Yeah.
Yeah, you know, it's well, actually pretty much on the number on the 50. You know, it was support on the way up. Sorry, it was resistance on the way up after the dip. And now we're just trying to work out, we're going to stay above or hold below. A bit of uncertainty right now. Taking a little pause for breath, I think.
And yields look like they want to push again. Keep having these little pullbacks, but then it looks like they want to go. So I still think that the yield yen relationship is they're still going together. They really didn't break up. What do you think?
It's a bit like a San Francisco tram. It hops on, hops off, hops on, hops off. You know what I mean?
Yeah.
The correlation. 1 minute is, you know, today you could say it is, you know, 10 minutes time or after the data, it could be completely broken again. So it's really, on and off at the moment.
So, you know, I'm long miners and silver, but, you know, I guess I have to point out, and this is something Blake talked about for a while ago, what's going to happen to gold? Well, look, the 200 week is there. And a major breakdown there.
Yeah, Stel was talking about this on the flow show this morning.
Yeah, good morning.
Good morning,
mate.
Stel.
1680 big level. I've actually, you know me, guys. I'm a very big bull in the medium term. I've actually gone short gold here. I said that on the flow show. 1687. I think it's more than 50-50 chance that we're going to break the lows, and we'll see where the flush takes us. I've got to stop at 1699, and I think we do break. We're going to get close to the low 1600. So I think it's like a 3 or 4 to 1 risk reward with I think 50-50 or better chance. So, you know, this kind of statistics I like. And of course, it could bounce, but I think the market really wants to see what happens below 1680.
Wait. Good morning, guys. Hey,
yeah,
I know. Yeah, Blake thinks he's in the twilight zone. That you're short gold. Right?
Can you give me a percentage again?
I think it's 50-50 or slightly better than that we break the lows.
Is that scientific?
That's what I think.
Oh, then it's not scientific.
What do you think? What number would you put to it?
That we break down?
Yeah.
I think it's actually higher.
Well, there you go.
But that is so unscientific, it's not even funny.
Trading is an art. It's not a science.
Yeah, and good morning, guys. I had to chime in just because it's
you had to make fun of me. Thank you.
No, I'm not making fun of you.
Well, Steve isn't here.
I'm just saying you look, I trust your gut way more than I trust my gut. So it's good to know that you think it's like 50-50. I think it's higher that we're leaning into it. We're leaning into this level.
What can I do for you?
Great to have you. Huh?
Hey,
great to be here.
But wouldn't you guys agree? And Stelios, I gotta ask you this though. But wouldn't you agree? Gold's scary heavy. Like, I know we've talked about it a lot, but it's not even bouncing.
Yeah, I agree.
Yeah,
I agree. In the short term, it feels very, very heavy.
Yeah,
and the other thing I wanted to say is that it's very difficult when you have high conviction on something. Like I'm a bull in metals in the medium term. It's very difficult to go against that. And I fought long and hard with myself, but I think it's a very good risk reward to do that.
Who won the bad guy or
the evil me won? Yeah. Anyway,
so I was.
I hope you're okay. You didn't hurt yourselves.
I was gonna mention you warned this yesterday in the chat room, and I was actually quite surprised it didn't happen yesterday. You warned everybody like, "Hey, we're getting really close to 1680. Don't be surprised if we break down in Asia." And I think there's a lot of traders that haven't been around long enough to remember those days. And in Asia, when liquidity dries up,
one Asia session, it was down like 50.
Those Asian sessions when they decide to move precious metals. I mean, I remember
I was long when they were doing that.
Oh yeah, they move them aggressively. I mean, you could see 40, 50 pip moves in gold during those hours, and I think you have to be paying attention, especially those of you that have not been trading for a long time. Because Stelios, I was surprised actually. I was surprised we didn't push lower last night because it felt like it, right?
Yeah, me too. Actually, me too. Yeah. And that's a sign of strength. But yeah, I still think we're probably going to be going lower.
Yeah, but this gold weakness, Stel. If you guys missed the first wave in silver, to me, I don't. Unless gold goes to 1400 or something like that. This still looks like, we're getting some type of ABC, and actually gold, the weakness in gold and some risk off is what would give you an entry on some type of retrace halfway back. I think it's something like 1880 or something like that. So look how well silver is holding up. I think it will cave with gold, but I don't see 1750 again.
No, I don't think we're going to test those lows, but if gold does break below, silver will have to follow. There's no way it can't follow. Yeah.
Yeah, but I think it sets up a buying opportunity in silver, don't you?
Of course, I agree. I've done it twice in the past few weeks, and I'm going to do it again. But you have to be patient.
A level? If you got like 1860, would you do it?
I'm not sure yet. I'm going to look at if we do break lower. I'm going to look at price action. I'm going to look at a lot of things, and I'm going to then decide.
Let me talk to the guy you were fighting with for a minute.
Oh man.
Anyway, Ryan, what are you really focused on here this morning?
Quite a bit actually. I've just funny enough, everyone talking about gold shorts. I've just taken a long. I'm going for a long play off that level with a stop reverse if it breaks. Okay. I've been loading up some shorts into $1. We've broken that 7 handle, so it's looking a bit dodgy at the moment. But euro all looking a bit flat right now. There's moves going on elsewhere, as I say. Gold is obviously looking a bit iffy. So got a ton of data coming up at the bottom of the hour. Empire, Philly Fed, retail sales, jobless claims. Could be a bit of a chaotic few minutes.
Maybe it's a day for both gold and S&Ps to break down. So Blake, similar line. You have a similar line here, not that far from a breakdown.
Well, yeah. Hey, Ryan, you were just saying, and I think we should probably point out the data that we have coming out today. We have Philly Fed, retail sales, and what else?
Empire and jobless claims.
And jobless claims. And if I'm not mistaken, the Philly Fed and the Empire State data will give us a glimpse of September data, like the most recent.
The first manufacturing data of the new month. Usually we get.
So we're going to be able to get some kind of a feeling of inflationary data, the most recent. So, which is important.
That sort of thing.
Yeah.
But also
does the Philly Fed make cream cheese? Oh no, that's Philadelphia cream cheese. I'm sorry.
Thinking of your stomach again.
I haven't had breakfast. Hey, let me ask you guys something. I know it's not market related, but after you've had something to eat, do you start thinking about what you're going to have next? Ever?
Depends how much I've eaten.
Blake?
Somebody's in a good mood today, Dale.
Who?
You.
Anyway, I just was wondering because I'm like all.
I'm wondering as well what the reason is. I don't want to openly ask, but
I know what you suspect. Anyway. Anyway,
Did somebody get some last night? Is that what we're saying? Sorry.
They opened a new pharmacy near me. Anyway, so yields, I guess, are going to drive this with Philly Fed. Anyone have targets on like 10-year notes or anything like that?
We've got a big level, 3.5% here.
Yeah, right here.
Quite high in June.
Look at this.
Ray Dalio, by the way, since we're talking about yields and how much they can climb, Ray Dalio was telling the other day that he believes that rates will rates anywhere between 4.5% and 6%.
Wow.
And that he thinks that would equate to another 20 to 25% lower move in equities from where we are.
Yeah.
Okay.
He's not the only one. That Scott Minerd is saying that too.
3,300 the S&P. I said this like months ago. Come on, Ray Dalio. Get with the program.
Speaking of which, and I don't think he made any mention in that, but I want to make a mention in that. We've talked about it in the past. Oppositely from what was happening in the past, the government is not, the maturities of the debt of the government are really, really short term, right? And many people don't realize or don't appreciate what exactly it means to have a big part of the debt, which unfortunately is in T-bills, 6 months, 1 year, etc.
Yeah, it's worse because
just to give you an idea, I remind you that the government's revenues from taxes are roughly 4 to 4.5 trillion, right? Depending on the year, how the economy is doing, etc. The cost of repaying the debt is around
just the interest.
600 billion, right? Just the interest.
Yeah.
Now imagine re-rolling, if this lasts for several months, re-rolling a big part of the debt with double the rates. I mean, this is extremely, extremely dangerous, right?
You sound like Luke Roman today. I mean,
we're talking about a potential debt spiral because doubling
default.
Listen, the US government will never default, right? Why? Because it has its own currency. So not a direct default, but how exactly will the US government afford having to repay double the amount?
Cutting Social Security and Medicare.
Just print more, monetize it. Come
they'll
on.
cut programs. And it depends on the election, but they will.
In any case, many people don't appreciate that aspect of increasing rates. And I think it's very important to take into account.
So maybe they won't. Like I asked Danny yesterday, I said, why do they want to wreck the economy? Steve, why do they want to wreck the economy? They know that, what they're doing. They know what they're doing.
Once again, I'm going to express my my difference of opinion here. I don't think they're wrecking the economy with what they're doing now. I think they've been wrecking the economy with what they've been doing the past 15 years. Yes.
Yeah. Okay. But
so it's now all about doing some kind of damage control because, as we've said before, inflation is a very, very, very toxic thing, right? So it's come to the point that
I like toxic better than cancer. That's good.
Yeah, the thing is that we've come to the point that there are no pleasant or easy solutions. You have to swallow one bitter pill. Now you have to choose which one it's going to be, right?
Yeah. Or it'll be both. First one, then the other. You know, a lot of people are saying severe bout of disinflation. And then when something breaks,
I don't subscribe to
like ever before. No?
I don't subscribe to the disinflation theory when inflation is still almost at double digits. It makes no sense. You know what I mean?
Asset deflation.
Oh, yeah. That's a possibility.
Yeah.
That's a real possibility.
Yeah. Okay, Blake, you want to come in here and?
No, I'm good. I'm
some
just
of your
listening. I'm just listening to you guys go on and on and on. No, just kidding. I just want to say I was just doing something else. But Steve,
Euro pound breaking out.
Huh?
Euro pound's trying to break out.
You know, we're getting close. Ryan, I know you're trading the euro sterling right now. I mean, this 87 and a quarter is a big deal, right? And here, I'll take the charts. It is. So what are you doing? What are you doing with it here? Because I know a few people are kind of leaning into it, like kind of on the short side, but it looks, I mean, Dale, good eye here, because I wasn't even looking at it this morning. So, I mean, it looks like we're trying to break higher. And I think, I mean, the risk reward is you short it, right? But the breakout above 87 and a quarter means business.
Yeah, I mean, I was short, been short a few days now, offloaded in the drops. I'm considering adding back into that position. It is a big level. I still don't feel like euro sterling is moving because there's fundamental differences between Europe and the pounds. You know, anything's changed in those fundamentals. It's purely moving around because of the volatility difference between cable and euro dollar. So I'm pretty neutral over direction right here. You know, I don't think it's ready to shoot higher nor break meaningfully lower. So you just got to rely on the text and the levels. And when you get the big levels like the 87 and 0.25, that sort of thing, or 87 and a quarter, you know, I've got more conviction to give them a go just purely from a technical perspective.
Yeah. Okay. I mean, so, you know, yesterday we sat in the and we were, you know, sitting in the chat room talking about, you know, rate expectations and the Fed and, you know, what the BOJ and oh shoot, I thought I had it on here. I don't have it on here, but Chris Weston, I was with him last night and he was he gave me an example and I posted it in our chat room.
You were with him last night?
Doing the trade-off.
Okay.
And we were discussing how to measure and find the terminal rate on TradingView, and he gave me the calculations, which is cool. It shows the terminal rate at like 4.33%, and that's what the market's expecting right now, but it continues to surge higher. I think it, you know, could get to 4.5%. We have some people thinking 5%. But the question is, you know, can the ECB and the Bank of England catch up? And there was just some comments from the ECB just a moment ago that came out from, let me find the comments because I posted it in the, oh, here, if you guys want to see this is the chat room, just so you guys can see. So ECB's Centeno, any comparison to the Fed and the ECB policy is unwarranted. And, you know, I added because they're just not going to be able to play catch up. Right. And so the question is probably, you know, and this, by the way, this is the ForexAnalytix chat room. If you guys want to see, you know, just our comments and charts and stuff like that. You know, we're, and this is from last night. Sorry. That was from the trade-off. So I guess the question is for you guys, I mean, you know, you look at the sterling, you know, is just getting smashed here, you know, versus the euro. Is this a lack of, you know, people look at the ECB and say that, or the Bank of England say there's no way they're going to be able to raise rates and keep up with even the ECB? I mean, what are your thoughts here? Why is the sterling so heavy? Anybody? Bueller? No, did you have do you know why the sterling is underperforming so badly at this point? Is there anything that I missed while I was sleeping, Ryan?
I don't think so.
Okay.
Unless Someone's got something. No, I've not seen anything today.
Okay. How about you, Stel?
Bill?
It sounds like you're going to say something.
No, I was going to say nothing came out overnight or something, but the problem is what's positive about sterling in the
Exactly.
recent weeks and months. I've been saying euro pound, you look for shorts only when we get to 90. I've been saying this for weeks, months probably. So
and Stelios, if I may add, when there is no short-term explanation about moves, what I usually do is that I revert to the longer-term view, right? And what do we know at the moment? We know that the UK has been more or less in a political turmoil for years now. They've changed like 5 prime ministers in just a few years. They've started to resemble Italy in that respect, A. B, the UK inflation is the highest probably among the developed countries, right? And the BOE is still very much behind the curve. So in general, somebody can make arguments that, perhaps the British pound should have been doing a little bit better than this or that currency or whatever else. But bottom line, as you said, there isn't anything really much positive.
Yeah, I mean, why would you be long the sterling right now? I don't get it. I mean, I'm just looking at, and price action's clearly bearish right now, right? It is just clearly, and you look, and then you start looking at it on the crosses. I was actually looking at the pound Aussie. I don't know where it's at right here. I was looking at it earlier this week. I was thinking, oh man, if this thing breaks 172, I am gonna get long, and then. And that was like early this week. And then what happened is we rejected it yesterday, and it rejected so hard. I'm like, why would I want to be long that? We can't even get above that. Not even close. Like we hit it and we just backed off so quickly. That price action right there says you don't need to be long sterling here. And that's just another, proof of, you start to see the euro sterling going up towards key resistance. Pound dollar. Now, I would say, and I would argue, getting too bearish while you're down here at channel support, which comes in, below 114. So, because if you are chasing sterling weakness and you look at this chart, every time you chase sterling weakness into new lows, you get your ass handed to you, and that's happened on multiple occasions. So, I don't know if I would just start buying, sterling down here just because it hit a new low, but it's something I think we should be watching. Now, let's also talk. Are you guys watching this gold?
Gold is getting there. Yep.
Gold's starting to get a little squirrely here, and I have to imagine there are so many stops. But just take a long-term view of gold, and just take a look at this. This is a weekly chart. That is the 200-week moving average, not the 200-day moving average. It meets us right where we're at. Look at all of this open air right here, and look at it right there. I mean, there is a lot of open air.
I don't think gold can escape. Its fate.
I don't think so either.
And if you draw little eyeballs like this, and then a nose, and then a mouth, and then some weird hair, and then you get
it looks like
hands, me. And look, it looks like it looks just like Stelios. All right, so I'm joking about that. Okay, so but there is a lot of open air here that I think you got to be very careful if you are long. And then I tweeted this using the ForexAnalytix Twitter account, but I have to say this. If gold breaks down, you do not want to be long dollars or short dollars, excuse me. Okay. If one of the biggest and probably most I don't know, the strongest relationship out there in the markets. And I'm just going to pull up something that I don't normally pull up. Let me just I'll pull up date cap. Let me delete this real quick. But if you look at gold and just compare it to the dollar, so one of the strongest inverse relationships on the face of the planet really is just gold and the dollar. They're like oil and water. So you don't see them move in tandem all that often. And we have to be under really, really strong duress, like very, very risk off type of situation where bids are getting hit all over the place for the dollar and gold to actually go up at the same time. Typically speaking, 90 some odd percent of the time, you're going to see a move in opposite direction. So if gold breaks down, the dollar should rally quite significantly. So be careful if you're long, you're long euros or, short dollar Norway. I don't know, whatever you decide to be trading, just keep that in mind. Hey, we haven't heard from, have we heard from K-Man this morning?
No.
Whoa, is he here?
I am. Good morning.
K-Man, hey, how you doing?
Yeah, I was patiently listening to what other people have to say. Very interesting.
Well, hey, how are you feeling today about everything? What's your thoughts on the markets this morning?
I think it's the FX market at least is trading risk off. It's likely has to do with this gold being heavy as well, and risk off translates in usually higher euro crosses. Yesterday we had the opposite, and as a matter of fact, the assets were trading a little bit better yesterday, correcting the day before, and euro crosses were heavy. And today we're seeing exactly the opposite. We're seeing euro Aussie higher, euro CAD higher, euro sterling higher. And regarding to the sterling short-term move, there's somewhere I mean to have heard over the past hour or so that the government said that they would still not apply any controls on borders. Kicking the EU against the shin again, I guess. So I take it all together. I think that's what the moves are this morning. And euro is pretty resilient, I must say. Euro versus dollar.
It's weird, right? I mean, the euro.
Look at the differentials. The euro, the short-term euro and dollar differentials are narrowing again, a little bit surprisingly, in my opinion, today.
All right. Well,
and what I've been saying already, I think the euro dollar is still in a bit of weak, but in a range, and the rest is going to gravitate around really.
Well, that euro range, I guess right now, and we could probably get a little bit more stricter with the details here, and if you look at this, this is probably the range between 101 and 99 cents, something like that.
99, 102, yeah.
Yeah. And this is I know I'm always cognizant of this trend line as it comes into play every time, because it's capped us all at 2022. If that stays intact, then it's going to be a lower range top, but we might be developing this bearish wedge, and this could develop is K-Man, as you're saying. I mean, this could develop literally for a couple more weeks, and we could see movement on other pairs, right?
Is holding, give and take 20-30 points. The battle for parity will not be lost, and the top side, we just had the proof. We had 2 attempts up there, and it capped. The numbers should be coming out in about a minute and a half.
Yeah, I'm pulling up the on ForexAnalytix. You have the data flash, and so I'm going to grab that really quick. Move that over here. And I think today's data, like I said, today's data is going to be, kind of a first glimpse at September inflationary data. So we need to pay a little bit closer attention to it today. Could move the market. Let's go. We got yields. We have the S&P, and I think we could probably just keep it on the euro. I know the euro is not moving a whole lot, but there's a 50. Oops, I didn't want to do that. There's a 15-minute chart on the euro. Let me just remove this stuff really quick. Okay, and I'm going to pull up the data flash. Any last minute words, guys? We have 30 seconds.
I think the combination of everything could be moving markets today, because we got industrial production later as well.
Yes. Lots of data coming out. All right. Well, Dale, what are you thinking? We got a couple seconds.
I'm thinking that yields want to push higher. I'm thinking that the end one more push higher. So, perhaps the data will reinforce a technical view.
All right. Well, here we go. We got 5 seconds to the data. Keep an eye on the markets right here.
Empire soft, not as soft as expected.
Empire big beat actually.
Jobless claims
better.
Down. Yeah.
All, you know, I mean, not core retail sales are down a little bit. We're not seeing much of them.
Retail headline up 0.3 versus flat expected. 0 on the core sales, flat on the core sales. Nothing.
You know, I'm sitting here looking at this gold, and it's just hovering right near its lows.
Billy Fed miss though, big miss.
That is a big miss.
New orders worse than expected. Prices paid lower, quite a bit lower than last time.
So there's your inflation view, really quick.
You know, before the interview, I noticed that Greg is here. Greg was at last decline in TLT and say notes or bonds 5, and we finished down there because I'm seeing something that looks like maybe an ending diagonal or 3 drives there.
Is Greg?
See Greg.
Yeah.
Oh, there he is. Okay.
Yeah, I'm here from the start. I'm just listening in. I'm like Cayman today.
Okay. So Dale, you were asking about, what were you asking about?
About bonds.
Okay. Yeah, I think that yields has room for 4%. I'm looking at some technical levels up there, and think that US dollar obviously at the same time has room for more weakness. And if we try to merge this with the S&P 500, you were showing there earlier that trend line connected from 2022 lows. Right. I just think that this one is going to see to break to the downside, and then dollar will just maybe accelerate. I would pay attention to Aussie. Aussie is now testing this big level around 670. Keep in mind that dollar Chinese yuan just broke to the upside today, which obviously has a lot to do with gold as well. So it looks like that correlation suggests that we are in a risk-off mode going forward, and the dollar has room to fly.
Okay, thank you.
Yeah, and I was going to say the Aussies was my chart of the day yesterday.
Well, I do have a guess.
Can I just add that on the long-term charts, if you take from the Volcker high to the 2020 pandemic low, the 10-year yields, the 23.6 retracement is 4%.
Ooh, 4%.
Okay, so we have some cluster up there.
Good to know. All right. Well, hey, A-Team, I want to say thanks for everybody's comments today, and it's good to hear everybody's voices, and I think today is going to be a busy one. So you know, you're not going to want to leave your seats. Make sure you visit the Trader Funding Program. It's our sponsor of today's show. If you want to learn how to trade our money and not risk any of your own money and keep 75% of the profits, watch this little video right at the very bottom of the Trader Funding Program. Watch this little 2-minute video, tell you all about the program. All right, guys. Thanks everybody for joining in. Dale, have a great interview, and we'll talk to you guys soon. Tomorrow.
Thank you, Dream Team. And I don't say it lightly. Dream Team makes dreams come true. I'm the nightmare in the group. All right, so everyone, Steve Miller, get ready for Steve. He's an excellent technician, very thoughtful market tactician as well, and great to have you back, Steve.
Hey, it's great to be here, Dale.
Yeah, it's been a while, and you know, you went through COVID and you were traveling, and
so we were out back in Chicago when the last time, and I had to cancel with you because we got COVID, my wife and I, and it was we actually had it for like a month, and but now we're getting back and recovered.
All right, buddy. Well, you know, I'm very interested in what you're seeing. You know, we're approaching fall here, and seasonally, if I was correct, I think you were looking for some type of top the last time we talked in the June-July timeframe, or something like July.
Yeah, actually, you know, the beginning of the year, we called this year, 2022, a bear market year for the stock market, and of course, that has certainly been correct. And
you want to share your screen?
Sure,
bro?
sure. Let me
get
the screen up here, and you should right now see my S&P chart. This is going to look messy and foreign to a lot of people. Can you see that?
Yeah, I just had a flashback to in my college days.
Yeah. Well,
Go
let
ahead.
me just very quickly spend just 30 seconds to explain what kind of a chart this is. You notice on the bottom, these are called cycle brackets. We're cycle analysts here at Ask Slim. And what we look for is the energetics in the market. Essentially, this is the ideal energetics, these cycle brackets on the bottom, and how they actually resolve in real cycles is just phenomenal, because you can see the movement in here as it follows the energetics on the bottom. And once you get what's called a negatively configured cycle, like right over here, we had a good idea that we had a top in place. So I'll zoom in on this so you can get an idea of to where we are right now. And we had anticipated that the market would be negative through the third quarter of this year and then get into a more positive period. Now, these yellow areas here are where the greatest period of risk are. That is when the minor cycle and the dominant cycle nest, and that's where you get the biggest downside movement. And you can see that's where we are right now. So we had believed that these little upside rallies that we've gotten, and the one we had last week was super intense. When you talk about 4 days of 230 points in the S&P 500, that was, very intense. And then it gets up into the resistance zones and fails. So I'm going to move from the weekly chart here to the daily. A lot of people follow daily more. And you can see in here on the daily chart, the same type of cyclicality. Those yellow zones bring the areas of the largest downside risk. And when you get a daily chart that's aligned in this negative period, just as the weekly chart is, that's when you really have a lot of downside risk. So we're anticipating that the market break that we had off of this little island or abandoned baby after that 230 point move is likely to continue down through towards the end of the month. So the fairly high probability that this low is going to get taken out, you can see that already down at this 38.86 area. There's some support right over here around 37.76, but there's a chance to get back down to that 36.36 level, which was the low that we made in June. And there's a pretty good chance at that. So the next 2 weeks have a lot of risk in the stock market. I think any kind of a little rally attempt in here will be met with a lot of selling on the downside. A lot of risk now in the stock market. And I think the lows for the year are probably going to be made here in these next couple of weeks, and then a little better time, an uptick, let's put it that way, in what is, I think, an ongoing bear market.
Okay, so another bear market rally after this flush.
Yeah, but I think it'll be a little bit more than, and last longer than these 4 or 6 day upticks than we've had. I think it'll be quite a number of weeks.
Okay, maybe into the spring?
Doubtful that it's into the spring, because there's another, I'm going to go back to that weekly chart. There's another important low coming out over here. So that comes out into March. And I think that could be a time period where the market is getting hit very hard again. You can see the note here. Our members get these live charts. So out here in March, April is more likely a bear market low.
Okay, interesting. Into the solstice, equinox.
I don't follow that, but if you say so.
Okay, well, you have some things right here. We're near the fall equinox coming up here, and right around your 926 date.
That's correct. 926 is that is the mid range of that date. These two vertical lines right here on the daily chart are basically the cycle range where we expect the low to fall into that time frame.
I'm curious, Steve. I'm seeing some a decent pattern, plus sentiment is so negative on bonds here. I'm wondering what you see on the long end of the curve. Maybe TLT. Do you use TLT as a proxy?
Sure. Yeah, TLT is a good one. So let me just go to the weekly chart. And we had actually been extremely bearish on the bond market. And now what's going on is a very bearish occurrence. And that is, and I'm just going to show you these last several cycles right in here. And you can see the alignments of those cycles. And where there's an important bottom that occurred right over here. And when you get that kind of a bottom and a rally that breaks down, that happened right over here also near the peak, where you have, this translates way on the left side of this cycle. It says that there is a lot of downside risk. So this would, project out to maybe a short-term bottom in the bond market coming in sometime in November. But then rally attempts that really don't go anywhere. So yields could actually continue on the upside all the way into next year. This goes out to August, where that bigger cycle aligns. So we really think that, outside of minor tops in interest rates, the Fed is going to remain pretty tight. And once they get to a level of where they're finally pausing, then it's pretty likely that you get a feedback loop and commodities will soar, and they're not going to be able to, there's no pivots coming. We're not going to see that for more than a year.
Like they just stop.
Yeah, they just stopped. 24 years. I'm going to move over to the daily chart in here in TLT. And this is really weak. Now, our momentum indicators, this is the slim ribbon right over here, is still very negative. The slim ribbon, we call it the slim ribbon PO, about to give another downside arrow. So the bond market is exceptionally weak. So what we're anticipating really is that when they get to a point where the markets believe that the interest rates are peaking and the Fed is done, the commodities will surge. And when that happens, this feedback loop will keep them very tight. So I think they're going to stay tight for a very long period of time. And they're correcting 24 years of madness, going all the way back to, Greenspan, the leader of this activist, crazy Fed that has started all of this, and, Yellen, Bernanke and Yellen following through, and now Powell completely messing the whole thing up. So all of that means that, their great experiment, which has now ended, they've lost credibility completely, and now they have to get that back. And the only way to get it back is to wash out the inflation, which is going to take a long time to do, with both the feedback loop in commodities, which I'm sure is going to happen, and the fact that all of this embedded inflation that's in wage inflation, and the fact that the CPI, PPI, there's a ton of catching up to do in there. Because the input costs are just really they're lagging on that. They need to keep raising prices. So that's going to be a long time that it takes to wash that out of the system, and to get their credibility back, maybe years. So forget about this whole madness that they've been in zero interest rate policy. I mean, they're pegging 2%, and they're going to go for that.
Okay. Does this mean the continuation of a strong dollar? Everything you're saying.
Well, I think the
sure
dollar.
smacks of it.
I think outside of what I think is a corrective time coming in the dollar, I'm going to go to the weekly chart right over here. I think you can't analyze the dollar if you're looking at it in terms of the DXY without analyzing the yen. The euro, because the euro is 57% of this index. Right. Mm-hmm. So you can see in here that we have a note in here for our members. The euro trough is due at the end of October. So that means that outside of some little dips in here, that's why we have this upside in here projected to the top of this fib extension, which is up near 112, out in towards sometime in October, and then a dollar pullback in here. So, of course, when you look at this, you've got to say that, there's a rough time for precious metals in here. Sometimes the precious metals do okay when the dollar is strong, as they begin to anticipate a change in there. But we, all of this, I think there's a huge amount of negativity in gold market right now. And I don't think the gold market's going to do poorly in here. Yeah, it might test that last low. But then when you look at silver and copper, and platinum,
silver
all of
looks
them,
great. I mean,
they really look like they made bottom. So I don't, I think that you might be looking at this and saying gold is in trouble. I don't necessarily think that's the case, even though I think the dollar still has time to go up. Now, if you look at this cycle way out over here, this big cycle, what this does is say, well, the dollar probably corrects out towards the end of the year. But then this is a period of huge potential dollar strength, which is very much in alignment with what I'm saying about what I think the Fed is going to do, which is stay tight.
Right.
You know, and there's no, I mean, when you think about the fact that, you know, the Eurozone has now just raised by 0.75 of a percentage point from zero, you know, now they're at 0.75 of a percentage point. It's going to be pretty hard for them to do any kind of a real catch up. There will be time periods in there when that happens, and then the euro will do better. I'm going to switch over to the euro chart right over here. What do we have here? It's EUR, US dollar. And in here you can see, well, this is where we're projecting the low out towards the end of the year for the euro currency. So there's the earliest low is maybe out in around, let's say, late November or early November. That peaks, that's with that time period that the dollar can peak. So there's a lot of time frame in here, and you could see what happened. It got right up to the sell zone and backed right off. So the euro is going to have a very, very hard time getting any real upside traction right now.
Until
you can
late
see
November.
Yeah, and see this pattern right over here. This is a megaphone pattern that's, and I heard you guys talking about the fact that the euro is actually showing great strength. In fact, look at the cyclicality in here and how these cycles match up so perfectly. And right now it is trying to make a short-term bottom right in here with that megaphone. And you'll notice the negative momentum here, this where it was red and now has neutralized. This is really saying to me that, you know, the dollar is probably going to have a minor correction out over here. So this period out in here, interestingly, that September 26th date comes in again, is probably a point where the dollar is going to have a minor pullback. And maybe that's a point where gold can get away from this trouble area out over there into October. I'm looking for an October uptick here in the metals. I'm jumping all over the place, but the correlations are so important.
Okay, interesting. I know a lot of people that, you know, like the market, we're looking for a seasonal decline starting this week into early October.
Which market are you referring to?
Mainly S&Ps.
Oh, okay.
You know, guys like Larry Williams, Mark Newton, they had some negative cycles mid-month until early October.
Mm-hmm. Well, I mean, Larry Williams is great. I mean, they really respect him. So
yeah,
it's kind of in alignment with what we're saying right here.
Yeah. Larry says, you know, as traders, Steve, we live in the future.
Yeah, that's right. And if you're a trader living in the past, if you're living in the past, you've got a lot of problems.
Oh, especially with my past, Steve.
Yeah.
You couldn't imagine. Yeah. So anything you want to wrap it with? As everyone could see, Steve does very intricate, eclectic type of analysis, and you know, I look forward to seeing it.
Yeah, credit also to my team. We have 4 analysts here at FA.C.E, all working on the cycle analysis, and each one with kind of different specialties. So we offer a huge amount to our membership. And just a little promo, AskSlim.com is where you can see all of our 5 different membership levels, and there's a workshop there that you can actually take to learn cycle analysis. So I think if somebody learns a style of analysis, it's like in their blood. They never look at charts the same, because essentially we get a good sense for money flows, and you look at the different time frames to be able to really understand the messaging from the market.
So would you say that you pretty much come from a GAN perspective, that time is more important than price, like knowing when these cycles are peaking? And
well, we don't really align. We don't really align with GAN, but yes, there are very few styles of analysis that show time and price.
Right.
And of course, this is one of them. And I can't even imagine trading without a real good time perspective. I mean, especially if you look at a chart like this of the S&P 500, that, I mean, you can see the cyclicality in here is just incredible. Where you see the energetics in there. Remember, this is just money flow. It's money moving in and out. And if it keeps moving in and then moving out at lower levels, well, that's your trend and the downtrend. If it's moving in and out at higher levels, like, well, you saw way back over here, that's an uptrend. And you can see in here where our slim ribbon PO, which is our momentum indicator, it's proprietary, fantastic. This is all green, and it gives all of these upside signals in there. And it tells you that the market is likely to resume on the upside with positive momentum. And then you can see in here where it's red and telling you it's resuming on the downside. And you can see we just had that negative resumption signal right in there, and we're still in negative conditions of momentum. And that really is important to look at. Money is flowing out right now, even though you get these big upside panics that just don't last, because the intensity from the longer term is very, very strong to the downside. And that's
okay, and
the
I
importance
also
of
get
the
from you,
multiple
Steve,
times.
that despite everyone looking at that 1680 breakdown level on gold, that you feel that this wherever it stops is going to be a pretty good position type of trade.
Yeah, because if you look at the cyclicality in the gold, and I'll just look at this downtrend right in here, you can see the energetic where the money moves out in here towards the end of these cycles. And you can see in here, we're getting to the end of that right now. So were that to just, test or break down that area of that low, it would say to me, big deal. I mean, if anything, it's more of a capitulation area and likely to get a rally, especially with the other metals really strong.
Yeah, I mean, silver, gold could do that, break down, and silver looks like all it would do is retrace.
Yeah, I mean, if you look here, I have the silver money flow cycle overlaid on here, and where silver made its low was right over here.
Yeah.
And gold is in a out of phase cycle with silver right now. Mostly they sync up, but this is a time when they're not. And you can see where silver got strong right in here, and much stronger than gold makes sense based on this on the money flows. So
plus there was on the gold silver ratio, I don't know if you follow it, but there was massive divergence at 95. So that's when you could have gotten for 1 ounce of gold 95 pieces of silver.
Yeah, I look at that now and then, but not regularly. But that makes sense to me. So right.
All right. Well, I think I picked your brain for what I'm interested in here, Steve, and what I believe our audience would be. You want to wrap it with one more?
Well, I mean, we could certainly go back and look at the NASDAQ, which is, I think, important also because the NASDAQ is weaker than the S&P 500. And here you can see we're projecting the NASDAQ to get down at best down to about 11.6, again, in this very, very weak area right over here with momentum weak and signals continuing to tell us of downside momentum. So I would say that when you look at the NASDAQ on the daily there and you look at the NASDAQ here on the weekly, again, we're getting into final stages right over here. So they're both in a period where hard declines can come. And then again, we get a rally out over here in towards the end of the year that sets up what I think is another big bear market leg out into March. So I think, that's a good way to wrap it up and say, don't get fooled by what people will think will be a bull market resumption. There is no bull market resumption coming in here for a long period of time. Because the fiscal flows of money and the money from the Fed are gone.
Okay, let's Steve rests his case. Looks like there's some capitulation coming in gold in the market within kind of the same time frame.
Correct.
How many years of a bear market are you looking for, Steve? 3?
Well, there is a repeating cycle that occurs on the quarterly chart that is about 7 years long. And, I equate this period to the 70s. Or where we went through like this all through the 70s all the way to 82. So that 7-year cycle would begin again after this low, let's say in March. So 23, that would take you potentially out to 2030 as this long period of secular bear. And I think that you'll have good cyclical bull market moves during that period. But overall, just a very, very long corrective period. And I think the buy and hold people, the 60-40 investors are going to have a lot of problems in there because bonds and the stock market are resynced.
7 years of plenty and now 7 years of naught.
Yeah.
Sounds like
big
a number
big
I've
range,
heard
I would
before.
say. Easily 3,000 to 4,500, 4,800 on the S&P 500.
Got you, buddy.
Right.
Okay, my trading warrior, Steve.
Yeah, thank you.
And Steve Miller, and Ask Slim at Ask Slim, and your website address, Steve,
is www.askslim.com.
And Learn Cycles.
Absolutely.
Another quiver, another arrow in your quiver. So
and you'll never go back.
And I'm glad you guys are over it, and mending, and really appreciate your sharing, giving nature, Steve, to come here and share your work. I know a lot of time and energy goes into it. Thank you for being a giving person and sharing it with us.
Sure, Dale. Good to be here. See you next time.
All right, everyone. Follow him at the minimum on Twitter at Ask Slim. Okay.
Right.
And check his website out. Thanks, Steve.
Thanks, Dale.
Have a great fall trading season. Talk to you down the road.
You too. Bye-bye.
Bye-bye. Okay, everyone, that's a wrap. And you could join the team in 20 minutes for the morning edge. Good hunting today. And we'll see y'all tomorrow. Thanks again, Steve.